Okay, welcome back. Now let's do some multiple choice questions on standard number 157, which is fair value measures, a very, very controversial standard. We're going to do numbers 62, 65, 68, and 69. 62, 65, 68, and 69 are found on page 150. So let's take a look at this, okay? Number 62 on page 150. It says, according to standard number 157. Now, first of all, in the on the exam, if they give you a standard number, they'll probably give you the standard title too. Okay, so they're just being cheap and lazy here. They just don't want to type out the title. But 62 says, according to standard number 157, fair value of an asset should be based on the exit price, right? So is it letter A, the replacement cost of an asset? Well, that would be more like an entry price. Let's take a look at letter B. The price that would be received to sell the asset at the measurement date. That sounds like an exit price. How about letter C? The original cost of the asset plus an adjustment for obsolescence. No, that's like the historical cost. How about letter D? The price that would be paid to acquire the asset. Well, then once again, that's an entry price. So it's all based on an exit price, the price that would be received to sell the assets. The best answer for number 62 would be B, like Barbara. Let's take a look at number 65. Number 65 says, according to SFAS number 157, which of the following would meet the qualifications as market participants? Are they letter A liquidation market in which sellers are compelled to sell? No, they're not compelled to sell. Letter B, they're willing and able to sell, but they're not compelled. It's not like a fire sale. Letter B, a subsidiary of the reporting unit interested in purchasing assets similar to those being valued? I don't think so. How about letter C, an independent entity that is knowledgeable about the asset? That sounds like a good answer. How about letter D, a broker or a dealer that wishes to establish a new market for the asset? No, it has to be in an established market. So the best answer for which of the following would meet the qualifications for a market participant would be answer C, an independent entity that is knowledgeable about the asset. What's not good about answer B is there's a related party relationship in answer B because it talks about a subsidiary there. So they have to be unrelated parties. Okay, let's take a look at multiple choice. So the best answer for number 65 is C, an independent entity that is knowledgeable about the asset. Let's take a look at number 68. Number 68 says, which of the following is not a valuation technique that's used in the fair value estimates? Remember that you have the market approach, that's level 1, the cost approach, which is level 2, and then the income approach, which is level 3, where you use a present value of the discounted cash flows. There is no such thing as letter B, like Barbara, the residual value approach. Now, it's not just important to know what the approaches are. Okay, you also have to know where they are and how they're associated in the hierarchy. Remember, the market approach is level 1, the cost approach is level 2, and the income approach is level 3, and level 1 is higher in the hierarchy, and then that's better. Okay, so the best answer for which is not a valuation technique is the residual value approach. So the answer B is the best answer for number 68 for what is not a valuation technique. Last but not least, number 69. I just want to introduce you to the Black-Scholes-Merton formula. Black-Scholes, only because that's used so often in valuations of stock options. All right, so I just wanted you to be familiar with that. And number 69 says, valuation techniques for fair value that include the Black-Scholes-Merton formula, a binomial model, or discounted cash flows are all examples of what valuation technique? Well, discounted cash flows, that's going to be what? The income approach, the income technique. So the best answer for that would be A. Letter B, the market approach would be a quoted price for an identical asset, like what comes from the New York Stock Exchange or the NASDAQ Stock Exchange. The cost approach would be, the example of a cost approach would be to find a similar price, similar fair value for a similar item that's very like your item, like the Kelley Blue Book value. The exit value approach, that's just the BS answer. So the best answer for number 69 is A. You can choose A, but only if you're sure. Okay. Also remember Black-Scholes model. That's a popular way for them to estimate the values for stock options. Okay. And Phil will talk to you about that in shareholders' equity, which I believe is chapter 12, when he discusses standard number 123R, which is for share-based payments and employee stock options. Okay. All right. Let's go back to the notes, and I just want to point out a couple other things. they do talk about standard number 159 at the bottom, page 135. I just want to read over some. I'm not going to assign any multiple choice questions for this. I'm just going to point out to you the highlights of it. I already assigned you to read the outline in the back. Standard number 159 is just like standard 157 is really interspersed throughout the textbook, and when it comes to being applied to a particular topic, I'll go over it then. But just the most basic concepts beginning at the bottom, page 135. Letter D, like David, at the bottom, page 135, says the fair value option for reporting financial assets and financial liabilities. But to which you're saying, but wait, we just discussed standard 157. Wasn't that fair value? Well, yeah, but that's how to measure. Standard number 159 tells you when to measure and for what, okay? And standard 157 applied to both financial assets and non-financial assets, financial liabilities and non-financial liabilities. Standard 159 only applies to financial assets and financial liabilities. What it allows you to do in standard number 159 is to elect the option. And when you elect the fair value option, once you elect it, you're stuck with it, okay? You can't cancel it. You can't go back on it, okay? Once you elect it, you're stuck with it. It's irrevocable, that election. That's the terms they use in the standards, an irrevocable election. And things that you ordinarily not capture at fair market value, you are allowed to put at fair market value. For example, if you own greater than 20% of the outstanding shares of a company, you're considered to have significant influence over them. And APB opinion number 18 says that you have to elect the equity method of accounting. Okay, and use the equity method of accounting under APB number 18. You'll learn more about that when Phil or Mike discusses investments with you. But the thing is this. You can actually elect when you initially purchase that investment, or let's say that you actually only own 15% of the outstanding shares, and suddenly you buy more shares and it bumps you up to like 20 or 21% of the outstanding shares, and instead of electing it under standard number 115, you now can elect the equity method under APB opinion number 18. You can actually make that election right then and there, or when you initially buy the equity investment, if you initially buy it at 20% or greater of the outstanding shares, when you can actually make the election initially, but it's irrevocable. Instead of using the equity method of accounting, you can consider it as a fair market value asset and mark it to market at the end of every accounting period. So you carry it at fair market value in your balance sheet, and you have an unrealized holding gain or loss, and that's going to be shown in income from continuing operations. Typically, under standard number 115, available for sale securities are supposed to be accounted for under standard number 115, and because they're available for sale, all the unrealized holding gains and losses on available for sale securities under standard number 115 are supposed to go to other comprehensive income. We learned that at the bottom of page 5 of my handout. Unless when you first buy those securities as available for sale, unless you elect the fair value option. If you elect the fair value option, you still hold the available for sale securities on your balance sheet at fair market value, but any unrealized holding gain or loss after you elect the fair value option under standard number 159 does not go to other comprehensive income. If you elect the fair value option under 159 for available for sale securities, the unrealized holding gain or loss goes to income from continuing operations. Okay. Another thing, under standard number 115, if you own bonds, all right, and you intend to take the bonds and hold them to maturity, and that's called the held to maturity, a held to maturity investment in bonds. Under standard number 115, you're supposed to carry them at amortized cost, which is the carrying value from an amortization schedule, unless when you initially purchase those bonds, you elect the fair value option under standard number 159. If you elect the fair value option under standard number 159, even if it's a held to maturity investment in bond, you carried it on your balance sheet at fair market value, and the realized holding gains and losses go to income from continuing operations. So basically, whatever you thought you couldn't hold at fair value, you can hold at fair value. And if you hold at fair value, when you mark it up or mark it down, right, when it changes in value, the unrealized holding gains and losses from that election under standard 159 goes to income from continuing operations. But remember that election is irrevocable. So let's just take a look at, those are, and as we go through these different topics under the different modules, there is always going to be a section on standard 159. I'll point it out to you. Okay. On page 135 at the bottom, letter D, says the fair value option for reporting financial assets and financial liabilities. Standard number 159, issued on February 2007, provides that an election can be made to value certain financial assets and financial liabilities at fair value. A financial asset is cash, evidence of ownership interest in an entity, or a contract that conveys a right to receive cash or another financial instrument, or to exchange financial instruments on favorable terms. A financial liability is a contract that imposes an obligation to deliver cash or another financial instrument. So basically, this only applies to financial assets and financial liabilities. Financial assets, example of financial assets are like accounts receivable, anything with the word receivable in it, investments in bonds, investments in stocks. Those are considered to be financial assets. Financial liabilities would be anything like with a payable associated, like notes payable, bonds payable, those types of things. Okay. The fair value option applies to all financial assets, including available for sale, held to maturity, and equity method investments. The fair value option also applies to certain financial liabilities, firm commitments, that's like a contract, firm commitments that involve financial instruments, written loan commitments, non-financial insurance contracts that can be settled by paying a third parties, get this, warranty liability, as long as a warranty liability can be settled by paying a third party, and a host financial instrument that is an embedded non-financial derivative instrument separated from a non-financial hybrid instrument. The fair value method does not apply to consolidations, pensions, share-based payments, stock options, other post-employment benefits, exit or disposal activities, leases, financial instruments that are a component of equity. Okay? Let's turn to page 136. As defined in standard number 157, the fair value is the price that would be received to sell an asset or pay to transfer a liability in an orderly transaction between market participants at the measurement date. So basically, they're using an exit price strategy for the fair value. Okay, skip the next. We'll read it. A company can elect to measure the applicable financial assets or financial liabilities at fair value on the date an eligible item is first recognized, the date the entity enters into a firm commitment, the date a financial asset ceased to qualify for fair value treatment due to specialized accounting rules, for example, APB 18 and the equity method. For companies using the equity method of accounting, a company can elect to measure the investment at fair value on the date the percentage of ownership changes and the entity is no longer required to consolidate. Basically what that means is if you own less than 20% and you get up to 20%, and then you would have to use the equity method of accounting. If you own less than 20% of the outstanding shares and you suddenly get to 20% of the outstanding shares, then you would elect ordinarily under APB 18 that requires you to use the equity method of accounting. You can elect the fair value option and say, I'm not going to use the equity method of accounting. I instead choose to use the fair value option. Or let's say that you own 100% of the company, 100% of its outstanding shares, and you divest of its shares so that you now only own 45%. It's below 50%. You own less than 50% because, remember, control is greater than 50%, in which case you consolidate. So you divest of the shares of that company and you do no longer have a control relationship with them because you're under 50%. Let's say you own 45%. At that time, instead of using the equity method, which would usually kick in under APB 18, you can elect the fair value option. But remember, that election is irrevocable. Next paragraph. The fair value election, it just says the fair value option is irrevocable, the last sentence there. Then the next paragraph says the fair value option can be made on an instrument-by-instrument basis. For example, if a company has two different available for sale securities, security A and security B, the company can account for security A using the rules under standard 115, which means that all the unrealized holding gains or losses under standard number 115 would go to other comprehensive income. And then for security B, they can elect the fair value option. Okay, so it's instrument by instrument. However, if the fair value option is elected, it must be applied to the entire instrument and not just a portion of it. If the fair value option is applied to an investment that would normally use the equity method, it must be applied to all the debt and equity interests in that entity. If you apply the fair value options, let's just say you own greater than 20% of the outstanding shares of a company, and you should be using APB 18 and use the equity method of accounting, but instead you choose the fair value option under standard number 159. You can do that, but that's owning the shares of their common stock. Let's say that you also happen to own the shares of the preferred stock, and you also happen to own their bonds. So you have investments in their bonds and investments in their preferred stock. Guess what? You're stuck with the fair value option for all of it. So once you choose, you're stuck with all of it for the instruments from that company. All right? So it's company specific. So if you choose a fair value option because you own IBM stock, okay, and you should be using APB 18 because you own greater than 20% of the outstanding shares, but instead you choose a fair value option. If you own the preferred stock of IBM and the bonds of IBM, you're stuck with a fair value option for all of it. Now that is one nitpicky little thing that they would love to ask on the exam. Okay. All right. In the middle of page 136, it says if the fair value option is elected, see where I am in the dead center of page 136. If the fair value option is elected, any unrealized gains and losses are reported in earnings for the period. That means that the unrealized holding gains and losses from mark to market, because you put it at fair market value every accounting period, so you may mark it up or mark it down from one balance sheet date to the next balance sheet date. And the unrealized holding gain or losses go to income from continuing operations. Specifically, you'd probably put it in plus other revenues and gains if it's an unrealized gain, or minus other expenses and losses if it's an unrealized holding loss. Okay, so it goes in plus other or minus other on the multiple step income statement. Next paragraph, it says that additional financial statement disclosures are required if the fair value option is elected. Two methods are permissible for the balance sheet disclosure. You can, number one, present the aggregate fair values and non-fair value amounts in the same line with amounts measured at fair value parenthetically disclosed. So you say total fair value and not fair value, and in parentheses you say, well, this is the fair value portion. Or the second way is to present two separate items for fair value and non-fair value. So you say two lines. This line is fair value. This line is non-fair value. Okay, so it's either one line with fair value parenthetically or two separate lines, fair value and non-fair value. Okay. Then for the balance sheet, the notes in the financial statements must also include the following. So I want you to go ahead and just review what these disclosures are. The disclosures continue on to page 137. There's lots and lots of disclosures. I mean, for me, I just wouldn't elect the fair value method, fair value option under Standard 159 because there's too many darn disclosures. So they are items 1 through 6 at the bottom, page 136, and then at the top of page 137, then here's some other income statement item disclosures, so there you go. So just have a familiarity with that, okay, with that. All right, next thing, letter E. In the middle of page 137, I'm not going to assign, as I said, any multiple choice questions really because we're going to be going over those in the different modules because there will be when you elect a fair value option and when you don't elect a fair value option, and module by module by module for all the financial assets and financial liabilities. So we'll do more of them later. Letter E on page 137 in the middle of the page. Letter E talks about the development stage enterprise accounting. This should be per generally accepted accounting principles. Development stage enterprise is like a startup company. It's a brand new company. The only additional disclosure required is that cumulative amount from the inception of the company, from when it starts, of the losses, the revenues, expenses, and cash flows should be shown in an income statement and the statement of cash flows. Furthermore, the stockholders' equity section of the balance sheet would include a cumulative net loss because they don't have a retained earnings. Retained earnings is only there if you have net income. If you've just started up and you have just net loss after net loss after net loss, you have an account called accumulated deficit. Okay? And sometimes they call it deficit accumulated during the development stage. These statements should be identified as those of the development stage enterprise. So you use regular statements, plus you do cumulative type statements from the inception for an income statement and a statement of cash flow. All right? So I just want you to be familiar that that's called a development stage enterprise. All right, the next and final thing that we'll be covering in this module has to do with supplementary information. Supplementary information is not audited to the same amount of rigor as the financial statements and the footnote disclosures. Remember, the footnotes are an integral part of the financial statements. Supplementary information, such as what is disclosed as supplemental information under standard number 89, is extra, and it's called a supplementary information, and they just review it. They don't really audit it. So because it's supplementary information and it's not audited to the same level of rigor as the statements and the footnotes, it's less likely to be tested on the exam. So that's, first of all, I just want to tell you that. They do talk a little bit about the supplementary information in your book. You may notice that I skipped quite a bit of Module 7D. That's because, remember, I'm here not to make you into a better accountant. I'm here to get you through the CPA exam. And if I look at material and I say, well, I don't think they'd really ask that. I skip it. But the supplemental information, I do think it bears merit of looking at it. So we're going to take a look at that. They do talk about it beginning on page 137, about 2/3 of the way down the page. They do talk about constant dollar accounting under standard number 89, but I have a handout for that. And then they also talk about current or cost constant dollars, and on page 139, at the top of page 139, they have letter G, current cost accounting, but I have a whole handout for this. So what I want you to do now is turn to your handout. We're going to finish up what's going on here. Remember, I did assign you simulation. You are to do simulation number 3, just the section for the multiple step income statement and statement of retained earnings only, just that section. That section of simulation number 3 is found on pages 158 to 160. Now, regarding the handout for page 12. The handout for page 12, actually on page 12, it kind of like shares. At the top of the handout is earnings per share, which, by the way, that's going to be changing because there is an exposure draft on earnings per share. That's going to be changing next year. Okay, so, look out. Okay, for now it's going to be done this way, but it will be changing because there's an exposure draft on that. They're trying to converge it with international standards. Whoopee. Anyway. The bottom half of page 12 of the Financial Accounting Reporting handout talks about FARE Module 7, Basic Theory in Financial Reporting, letter D, Financial Statements, Statement of Financial Accounting Standards number 89, Financial Reporting and Changing Prices. Now, what this basically does is has to do with historical cost constant dollar accounting, which is inflation-based accounting, and then current cost accounting, which has to do with changes in values because of changes in demand. Okay. Nobody requires you to do this information. However, if you choose to do it, you have to put it as supplemental information to the financial statement, so it goes behind the footnotes, and it's supplemental. It's not audited to the same level of rigor as the financial statements and the footnotes. So if you choose to do it, you have to follow the accounting standard, standard number 89, okay? There is no requirement that you have to do it, so it's completely elective. So you elect to do it. If you elect to do it, you have to follow the standard. Now, over here, we live here in Maryland and Montgomery County, and in Maryland and Montgomery County, like the end of our metro line is called the Shady Grove Metro Line. And across from the Shady Grove Metro Line, they have this farm that was called the King Farm. And the King Farm, it used to be a farm, and now it's houses and condos, and it's all developed. Okay. And what happened to the value of the King Farm? Okay. What happened to the value of that farm was that it increased in value because of 2 reasons. The 2 reasons it increased in value was because, number 1, because of inflation, and number 2, because of demand and market appreciation. Because as soon as they opened up the metro, which is our subway system here in Washington, D.C., as soon as they opened it up across the street from King Farm, hey, everybody wanted to live there because now they could get there by the metro. And so the value of the land went up. But remember, the value of the land goes up for 2 reasons. Number 1, just because of inflation, and number 2, because of increases in demand or market appreciation. And you have to separate those 2. Okay, so that's why when you look at my handout, I have the left-hand side and the right-hand side of the handout, and this is accounting, it's the one accounting standard that governs it, which is standard number 89, which is financial reporting and changing the prices. Remember, it's supplemental, it is not required, but if you choose to do it, you have to follow the accounting standard. On the left-hand side, we have inflation-based accounting, which is also known as historical cost constant dollars. On the right-hand side, we have changes in value because of increases in prices due to market demand or market appreciation. Okay. By the way, you can also have market depreciation. Okay, but market appreciation and market depreciation. On the exam, it's usually typically though appreciation. So you have the left-hand side and the right-hand side, and you have to separate the 2. Now, let's take a look at the left-hand side. In the historical cost constant dollars, these are increases in prices that are entirely due to inflation, and you're always going to be talking here about something like a consumer price index. So basically, what you're going to do is you're going to distinguish items that are monetary assets and monetary liabilities, and then you're going to distinguish those between that and the non-monetary items. So, first of all, on the left-hand side, monetary assets and monetary liabilities. What are they? Monetary assets are like cash, accounts receivable, notes receivable. A monetary liability is like accounts payable, notes payable, bonds payable, held to maturity investments in bonds. As a matter of fact, most liabilities are monetary liabilities. There are very few liabilities that are non-monetary. The only non-monetary liability I can think of, unearned revenue, where you have to actually provide a service. That is considered to be a non-monetary liability. But most liabilities are monetary. Monetary means it's fixed and determinable and it involves cash. Okay. A monetary asset is where you're going to receive cash. A non-monetary asset is things like inventory, property, plant, and equipment, goodwill, those types of things. So basically then you have monetary items, the monetary assets, and the monetary liabilities. So that's what they are. So what do you do with them? You're supposed to take your monetary assets and your monetary liabilities, you're supposed to net them. So when you net them, you either have a net monetary asset position or a net monetary liability position. So based on that net monetary asset position or net monetary liability position, you're supposed to calculate a purchasing power gain or loss. Now, they will never ask you to calculate the purchasing power gain or loss, but if they ask you, you either take your net monetary asset position, your net monetary liability position, and you multiply it by this ratio. And the ratio is the end of year consumer price index minus the beginning of the year consumer price index all over the beginning of the year consumer price index. I doubt they will even ask you that, only because inflation has been so low. Okay, but just know that you take the monetary assets and monetary liabilities, you net them together, and you calculate a purchasing power gain or loss on them. So what do you do with the non-monetary items? So what are the non-monetary items? Look at the column that says non-monetary items. So what are the non-monetary items? What are they? Well, it's anything that's not monetary is non-monetary. Okay, so it's everything else. What are you supposed to do with them? You are supposed to convert them. Now, they may ask you to convert them. How do you convert them? You multiply them by a conversion factor. And the conversion factor is the current period's consumer price index divided by the base year consumer price index. Don't worry, they will give you all these indices. Okay? So you take the current period consumer price index divided by the base year consumer price index. This becomes a conversion factor. You take the conversion factor and you multiply it by the non-monetary item. Okay? Remember what's a non-monetary item? Anything that is not a monetary item. Okay, let's take a look at a couple of multiple choice problems on this. Multiple choice numbers 74 and 75, please. 74 and 75, and this is going to involve historical cost constant dollar accounting. 74 and 75. 74 and 75 are found on page 151. 74 says, a company that wishes to disclose information about the effect in changing prices in accordance with standard number 89, financial accounting and changing prices. You see how they did that? They gave the standard number and the standard title. That's the way they're going to do it in the exam. I know in some questions they just give the standard number. No, they're going to give you the number and the title. Should report this information. Where do you report this information? Remember, it's supplemental information. Do you report it in the body of the statements? No. Do you report it in the footnotes? No. Do you report it as letter C, supplementary information to the financial statements? Yes, it happens after the footnotes. Okay. Letter D, management's report to the shareholders? No. The best answer for anything reported under standard number 89 would be supplemental information. The best answer is C. Let's take a look at multiple choice number 75. Number 75 says, the average consumer price index was 100 for 2007 and 110 for 2008. In a supplementary constant dollar balance sheet, which has been adjusted for changing prices at December 31st, 2008, these selected account balances should be shown at what? Okay, the Lewis Company was formed on January 1st of 2007. Selected balances from the historical cost balance sheet at December 31st, 2008 were as follows. Okay, whenever they mention consumer price indices, you're thinking that's inflation-based accounting. That's constant dollar historical cost accounting. It's inflation-based accounting whenever you see consumer price index. So what you're supposed to do is first take a look at all the items and decide what are the monetary items versus the non-monetary items. The land is a non-monetary item. What are you supposed to do that? You're supposed to convert that. Investment in non-convertible bonds, purchased in 2007 and expected to be held to maturity. Okay, held to maturity investments in bonds are monetary items. Long-term debt, that sounds like bonds payable. That is a monetary item. What are you supposed to do with the monetary assets and the monetary liabilities? You're supposed to net them and calculate a purchasing power gain or loss. But they're not asking us to do that. They're asking us, what should you do? Well, we have to convert certain things. The average consumer price index was 100 for 2007 and 110 for 2008. In a supplementary constant dollar balance sheet adjusted for changing prices at December 31st, 2008, the selected account balances should be shown at, okay, the investment in held to maturity bonds, that balance has not changed. That's still left as 60. You're supposed to net that and calculate a purchasing power gain or loss. The long-term debt, these are bonds payable, that's a monetary liability. You're supposed to net that with the monetary assets and calculate a purchasing power gain or loss. You don't change that value. So the correct answer can only be investment for $60,000 and long-term debt of $80,000. So the correct answer has got to be answer C. But the land, which is a non-monetary item, you are supposed to convert that. Now, that's called a mutually exclusive answer. The answer can only be answer C because it's the only selection where investment is 60 because it doesn't change in value, and long-term debt is 80, it doesn't change in value. But let me show you how they take the land and they can calculate the 132. Because the land is considered to be a non-monetary item, what are you supposed to do with the non-monetary items? You're supposed to convert them. What you do is you take the current CPI, you divide that by the base year CPI. This will give you a conversion factor. Then you multiply that by the amount of the non-monetary item. The current CPI is 110. And the base year CPI is going to be 100. So this gives you 1.1. That is your conversion factor. You then multiply that by the value of the land. The value of the land originally was $120,000, so times $120,000. That is then going to give you $132,000. So you can see that's how they get the $132,000 for answer C. Remember, under constant dollar, inflation-based accounting, which you're always going to see a CPI. That's the clue. When you see CPI, that's what you're supposed to do with it. You take your monetary items and your monetary items, you separate them from the non-monetary items. For the monetary items, you have monetary assets and monetary liabilities. What do you do with the monetary assets and the monetary liabilities? You net them together to get a net monetary asset position or a net monetary liability position, depending on which is more, the monetary assets or the monetary liabilities. Then you calculate a purchasing power gain or loss on those. Okay? For the non-monetary items, such as land, you're supposed to convert those. How do you convert them? You calculate a conversion factor, which is the current year consumer price index divided by the base year consumer price index, calculate the conversion factor, which was 1.1 in this example, multiply it by the non-monetary item to convert it to the convertible factor. Okay? This is now converted and adjusted for the consumer price index. Okay? So the best answer there would be answer C. Now, what about my King Farm, that the value of it rises not just because of inflation, but because now everybody wants to live there because they opened up the metro next to it. Okay? That's called current cost accounting. So let's look back at the handout. And when you look back at the handout, that's on the right-hand side of my handout on page 12. And these are increases in prices due to demand or market appreciation. People just want to live there, so they bid up the price. Okay, so what are you supposed to do? Once again, you have to divide between the monetary items and the non-monetary items. The monetary items are monetary assets and liabilities. What do you do with them? Oh, this is easy. You do nothing with them. Can you handle that? Can you handle doing nothing with them? This is pretty good. What about the non-monetary items? What do you do with those? What you're supposed to do with the non-monetary items is you're supposed to restate them. You restate them to the current costs, and then you calculate a holding gain or loss. So you restate them to the current costs and calculate the difference. The difference, if the current cost is above, you have a holding gain. If it's below, then you have a holding loss. How do you calculate this holding gains and losses? For example, you have property, plant, and equipment, and you have inventory. Property, plant, and equipment, and an inventory, these are, for example, are non-monetary assets. They are balance sheet items. Because they're balance sheet items, they're as of one day, the balance sheet date. So you just use whatever is the current cost as of the balance sheet date. Okay? And then the difference between the historical cost and the value as of the balance sheet date, that's going to be a holding gain or loss. Then, what happens if you have income statement items? For income statement items, such as depreciation expense or cost of goods sold, you have to calculate the average. And the way you calculate the average is you just take the beginning of the year plus the end of the year, you divide by 2, and that calculates the average for it. Okay? And then that's how you get the holding gain or loss. All right. Now, let's take a look at a couple of multiple choice questions on this. Let's take a look at multiple choice number 83 and number 84. Just remember, you have to separate the effects between increases due to inflation and increases due to market demand or market appreciation. Numbers 83 and 84. 83 is sort of on page 151 and hangs over to page 152. Page 151, number 83 says, could current cost financial statements report holding gains for goods sold during the period and holding gains at inventory at the end of the period? Okay, well, you only calculate the holding gains and losses on non-monetary items. So, is Goods sold during the period, that's cost of goods sold. Is that a non-monetary item? Yes, it is. Could you calculate a gain on this? Yes, you can. How about inventory? Is inventory a non-monetary item? Yes, it is. Inventory is a non-monetary item. Could you calculate a holding gain on that item as of the end of the period? Yes, you can. So the correct answer for cost of goods sold and inventory is yes and yes. The correct answer is A. Remember, you calculate the holding gains and losses on the non-monetary items. For monetary items, what do? You do nothing. So the best answer here is A. Yes and yes. Last question for this module. The last question for the module is multiple choice number 84. Number 84 says, number 84 is found on page 152. How should Manhoff compute the cost of goods sold on a current cost basis? Well, remember, cost of goods sold is an income statement item, so it happens over the entire period, so you're probably going to have to calculate an average, okay? The Manhoff company